AS number 27, financial reporting of interest in joint venture. Interest in joint venture. ABC Limited, XYZ Limited, ABC and XYZ. Here is IJK entity. Here is IJK entity. Clear? ABC also invested here. XYZ Limited also invested here. Right. See, in case of investing in subsidiary company where the holding is more than 50%, where it may be in business associate, the investment could be anywhere between 20% to 50%. Or if you are investing not to control that company, then it's merely investment. The investment range should be less than 20%. Less than 20%. Is that okay? This will be coming under AS number 21. This will be coming under AS number 23. And this will come under AS number 30. Now, here ABC controls absolutely yes. Subsidiary company is absolutely controlled by ABC. What ABC says, yes, should obey. In this case, ABC can influence the decisions of this business associates. In this case, it's merely for the capital appreciation as well as revenue generation. No more intention to control this. Now, in this case, what happens, ABC investors 50% and XYZ are also investors 50%. What does it mean? ABC cannot control and XYZ alone cannot control. These two together will control. So it will not be falling under what? Associate or holding company. Or if it is 60 and 40, only these two companies are there. Mutually, they will make the decision regarding the operations of IJK company. Then it is called joint venture. This entity is called joint venture, where ABC alone will not control, XYZ will not control here. Now, ABC has to prepare consolidated financial statement if they have subsidiary company. In CFS, you have to include subsidiary companies' assets and liabilities, as well as you have to include business associates' assets and liabilities under equity method. And in case the amount invested in investment company will be shown as investment asset side. Is that okay? This one will be line by line additions, like all the assets of holding companies, subsidiary companies will be added. To the extent held by outsider is named as minority interest. In this case, to the extent held by ABC Limited will be named as net worth. Okay, that will be calculated under equity method. And the last one is normally asset like. Okay, just like an asset will be shown in the asset side. Now, you have to incorporate the investment made in IJK also in your financial statements. This is all about AS number 27. Financial reporting of interest. Your interest. So in this case, ABC's interest in IJK being 50%. In where? Joint venture. Joint venture means this entity is not only controlled by ABC or XYZ, both together will form and draft themselves the rules and regulations to control XYZ. Then it is called joint venture. So at your foundation level, I hope you might have studied joint venture chapter, or in your UG level, you might have studied joint venture chapter. So the latest joint venture was removed from the CME foundation level, CA foundation level, and earlier we had joint venture as well as consignment as part of CA foundation study material. Thereafter, joint venture was removed, only consignment was there in CA foundation. Now, consignment and joint venture both were taken out at foundation level. Okay, so we have especially joint venture as per the accounting standards AS number 27, accounting standard 27 incorporated here. So it is not now required for foundation level. In case of CMA, no, still CMA level, still they have this one in their own foundation level study as well as inter level study. Okay, if you study foundation, you will study the joint venture and consignment. So under AS number 27, it's a standardized, more professional way and with lots of definition and variations of joint venture explained in detail here, and how it is going to be accounted also explained here. Is that clear? If you might have studied joint venture in your school days or college days, probably it may be available at your college days, or it may be available at your CMA foundation, CMA inter level. You might have having a small knowledge over this. So now we are going to study that in systematic manner. Is that okay? So joint venture. Joint venture is nothing but a contractual arrangement whereby two or more parties carry an economic activity under joint control. Two or more parties. Already told you, IJK and ABC, XYZ. These two will have an arrangements for the economic activity. This will have the intention to make some profit, economic activity. For that, ABC as well as XYZ will together will control as per the arrangements between them. This is called joint venture. The arrangements may be sharing of risk and expenses, collaboration of know-how, and sharing the skill set. Sharing the skill set. Is that okay? So ABC is also need of some skill set. XYZ also need of some skill set. ABC and XYZ will create a new entity called a Skill Development Institution. So they will call for various students to get trained here. After giving lots of training by IJK for a fee, whatever it may be, later on the trained employee may be absorbed by ABC as well as XYZ. So rather than ABC appoints, means recruits fresh candidates and training them in their own entity, they will now create one new entity under the control of ABC itself. They will collect the small fees from the students and give the training. Once the students are getting trained, automatically IJK will transfer their trained students to ABC for the employment. So just think over, there's an institution. If you get trained in that institution, you will be getting posted in some private banks. You will be happy or not. So most of the students are trying to get banking job. We have two banks like X Bank and Y Bank. And X Bank also in need of various bank employees, and Y is also in need. Or X, Y, Z. Three banks are there. X, Y, Z, and three banks are there. Now all the three banks started an institution, banking institution. Now what happens? Students are admitted here by giving the fees, and they get trained. After the training, if they qualify, may be absorbed by these three companies. So rather than appoint and train, now they will be taking the trained employees directly. For the training also, a separate division is there. This is called a skill set is developed in this and taken by this. So separate institution is formed. Okay. Let's see Hindustan, Tata Starbucks Limited, Tata Shia Airlines Limited, Vistara, etc. These are the examples, right? Clear? Tata Starbucks. So Tata and Starbucks, Tata and Shia Airlines. Okay. And named as Vistara. So now Indian Airlines is run by Tata management, right? Earlier Tata, actually Indian Airlines earlier was held by Tata only. Thereafter nationalized all these airlines also during Indira Gandhi's period. Automatically, because of the nationalization, though all the airlines held by the private players taken by the government, Indian Airlines went to government's hand. Sometimes later again, the Indian Airlines is transferred to Tata only, reacquired. So it's a great history, like you can go and see. Tata mooted the idea of running the airlines and started and running a grand manner in the very beginning of the independency. Sometimes later, because of the nationalization, those banks were taken by those Indian Airlines or other airlines, private airlines taken by government. Sometimes later, privatization was introduced. Okay. So after introducing the privatization, again the others are allowed to start the airlines industry. But what happens, Tata could not enter by the time. Meanwhile, they started their own airline services outside India along with SIA, okay, Singapore Airlines. Like so, with them they started the venture there. It is nothing but Tata and SIA both joined together to operate the airline system outside India. Is that okay? So these are called joint venture. Tata has their own entity. Other entities, SIA also has their own entity. They joined and mooted a new idea for a small business with an economic idea, means interest in economic benefit, right? Here, it may be XYZ company, ABC company holding IJK. Not necessarily XYZ company, maybe always company, it may be individual. This one also be individual or BOI or AOP or it may be company or firm. Anybody, any two entities like in taxation, you might have seen the persons, right? Individual, BOI, AOP, company and firm. Of course, cooperative society cannot be, and local authority and Hindu undivided family will not be there. Usually, individual, BOI, AOP, company, and firm can join together to start and operate a new entity for the common benefit. Is that okay? So, this is the main thing you have to understand. Financial reporting of interest in joint venture. Now, this ACE number 27 deals three broad types. Okay, otherwise named as joint forms of joint venture. One is JCO, jointly controlled operation. Another one is jointly controlled assets. Another one is jointly controlled entities. So we have three forms of joint ventures. So name itself will explain what it could be, right? Jointly controlled asset means the asset is purchased by two entities and the asset will give some revenue, will be shared by them. That's all, very simple. There may be a shopping complex, A and B joined together to purchase the shopping complex, and the shopping complex will be operated as it is, right? And then shopping complex generates the rent that will be shared. Or A and B together will purchase an asset where whenever A is in need of that asset, he will use, and whenever B is in need of the asset, B will use that asset. Is that okay? But based on their usage, the revenue may be shared. Also be possible. I need to have probably a hall. My friend also needs to have a hall. I cannot invest myself to purchase a big hall and my friend cannot. So what we can do? We both can purchase a hall. Whenever I am in need of using that hall, I can use it for some days and my friend will also use it for some days. So then that hall will be considered as jointly controlled assets. Okay. Jointly controlled entities is nothing but A and B put together, they will start a new entity, probably new business. Okay, XYZ and Co. Like a new entity may be started. And that entity will be operated as per the instructions of A and B. That will be called as jointly controlled entities. And jointly controlled operations. Some operations may be jointly controlled. Okay. Okay, like training. Here I explain, no, two banks together select and train the employees fit for recruiting in the banking sector. So only training is an operation is done by these two banks or three or four banks, right? Jointly, then it's called jointly controlled operations. An investor in joint venture which does not have joint control should report its interest in a joint venture in its CFS. Okay, in accordance with either this one or this one or this one, right? Clear? So usually A and B, and they formed a jointly controlled entity, and A also controls and B also controls. Provided A invested 30%, B invested 70%. A invested 30 and B invested 70. As per the mutual agreement, all the decision taken by B only. A has no role over making the decisions of any policy decisions in X. But revenue shared between A and B in the ratio of 30:70. And B says, sir, you invest, thereafter you don't disturb me. I will take care of all these things. Whatever the revenue left over, no, you can take 30% for your investment. So in this case, A has no control over X. Okay. Joint control means A and B together will control. If it is not so, this will not be falling under AS number 27, may be falling under investment, or it may be business associate, or it may be in the different form. It may be either falls under simply investment AS number 13, or it may be really I have 100% control. Then this company, for this company, it's not jointly controlled. It's subsidiary for him because holds more than 50% and dominates the other company. Other company has no role at all. Then automatically what happens? B becomes holding company. Okay. And for A, X will be merely investment. Merely investment. No, sir. A also can represent sometimes now and then. Then it comes under AS number 23. I can control 100%, then AS number 21 will fall. And I'm able to influence, then AS number 23 will come. And consultancy with others, only the decision will be taken, then AS number 27 will be there. No, sir, I just invested for the capital appreciation and regular revenue income. That's all. Then it is investment AS number 13. So 4 ASs are going to be studied along with 13, 21, 23, and 27. Clear? Now, AS number 27 should be applied in accounting for interest in joint ventures, right? So this is what about the case. The reporting of joint ventures, assets, liabilities, income, and expense, everything will be shown here, right? Before completing some theory here, let me explain the JCO, JCA, and JCE all the three. Okay, all the three we try to finish up. Let's start with JCO here. JCO. JCO is nothing but jointly controlled operations. Okay, JCO. Now, before I explain this, let me try to finish up this question. I try to finish up this question. Mr. A, Mr. B, Mr. C entered into a joint venture to purchase a land, construct, sell flats. So, A, B, C. They plan to have an operation, okay, only for temporary period. Then what's the nature? Purchase land and construct building and sell. These are the three activities are given. Involving in these three operations jointly. A purchased land rupees 60 lakhs. And for the purpose, he took loan from the bank for 50 lakhs at the rate of 8% interest per annum. He also paid registration fees 60,000 on the same day. So each and every person will render some expenses for the common operations, right? He also paid registration fees on the same day. Mr. A, B supplied. So what are the things are given by A? A supports what? One is 1121. He acquired land for 60 lakhs. Of course, for that he borrowed the loan, 8% loan, 50 lakhs. He also paid registration fees. So he paid the registration fee, purchased the land for 60 lakhs and registration fee 60,000 also paid, 0.6 lakhs. Apart from that, B also contributed. Supplied the material required for the construction, material, which is 4.5 lakhs, and from his godown, and further he purchased the materials 5 lakhs for the joint venture. So it is own source. Another one is purchased. Own source 4.5 lakhs and he purchased it for cash from outside being 5 lakhs. Similarly, C also supported. C met all other expenses of advertising, labor, and other incidental expenses which turn out to be 9 lakhs. So C spent expenses which is equivalent to 9 lakhs. On 3621, Each of the venturer agreed to take away one flat each to be valued at rupees 10 lakhs. When? By the end of the period, 36/20/21. Okay. So what these three will get, A, B, C, they will get flats. They constructed the flats, probably around 30 or 40 flats might have been constructed and sold a lot. They retain one flat per head. Okay. Valuing rupees 10 lakhs for all the three. Okay, and Mr. A for rupees, and the rest were sold and sales made by each and every venturers. A sold the flats in his name being 40 lakhs and B 20 lakhs and C 10 lakhs. So what happens now? They constructed flats, and after the constructed flats, three flats were taken by A, B, C. Rest were offered to various customers for a consideration. That overall consideration received being 40 plus 20 plus 10, 70 lakhs. Now, because of this jointly controlled operations, they are involving in some operations. Jointly controlled asset means they don't have any tension of doing that. So I purchased and let it work and generate income share. That's what about jointly controlled asset. Jointly controlled entity means they may start a business, like this business will have long life. When it's being the operation or temporary operation, maybe 3 months or 4 months, like that's what about jointly controlled operations in this case. So they constructed lots of flats. After the construction of the flats, each and every joint venturers, so A, B, C will be called as joint venturers, right? So these joint venturers take one flat each, the value of each and every flat being 10 lakhs. Remaining constructed flats sold for this much rate. Loan was repaid on the same date by Mr. A along with interest. So this loan was repaid. So repayment is also done, okay, along with interest. On which date? 36/21. You have to pay 8% interest on this for half year. Come on. 2 lakhs, I think. 2 lakhs interest is also added with and settled. And net profits were shared by the partners equally. What are the revenue they have? Net profits, net benefit shared equally. Okay. Net profit shared equally for all the three partners, equal share. You are required to prepare consolidated profit and loss and joint venture account in the books of each venturer. So you have to prepare the P&L account. P&L account is very simple, right? So you debit all the expenses, credit all the incomes, and balance is the profit. The profit will be shared by all the partners. Very simple. All the, rather than partners, we'll call them being joint venturers. Come on. Try to prepare. Yes, come on, tell me. Consolidated profit and loss account of this joint venture. Jointly controlled operation, JCO, involving some operation. P&L account, right? It's normal P&L account. What do you do in P&L account? Debit all expenses, credit all income. What of the leftover profit will be profit for the owners. Here, three owners are there, shared. It's like partnership, like. Okay, come on, tell me. Land. What about this one? Land is the expenses. Land is the expenses, not asset, because they are the builders. They purchase this and construct and sell, so it becomes stock in trade. And of course, the duration of this jointly controlled operation is only 6 months. If the duration is less than 1 year, going concern concept is in trouble. As going concern concept is not there, there will not be any assets and liabilities. To classify any payment being the asset, two conditions should be satisfied. One is the company should have the life more than 1 year. Second being the asset, the payment should give the revenue for more than 1 year. So these two conditions should be satisfied, only then it's an asset. But here, okay, land. But anyhow, the land is going to be sold in sometimes later after construction. So the life being very short. Apart from that, this entity also be closed after the completion of the construction. So both will be in short duration. So hereafter there will not be any assets. All the payment will be considered as an expenses only. Debit that expenses here. Debit for land. to land, value being 60 lakhs. I put in thousands, cut 3 zeros. Loan is not being the income or expenses. Only the interest component is the income and expenses. So registration fees 60,000 and material 4.5 lakhs, 450,000 and 500,000 from own resources from purchased material, and expenses 900,000. Now by sale by whom? By A 40 lakhs, 4,000 thousands, B 2,000 thousands for C, by A, by B, by C. So rather than simply debiting the expenses in the P&L account, you debit who spent this money also in the top, simply A, B, C. Okay, that one extra representation you need to have. And if the flats taken by them, what happens to drawings like? Usually drawings will be subtracted from what? From the purchases, or it may be treated as a part of sales like. But it should not have any profit component. So it's rather than subtracting from the cost, it can be posted on the other side. So here drawings, flats taken are drawings. By whom? A, B, C. Each and every joint venturer have taken one flat, the value being 10 lakhs. So 1,000, 1,000 and 1,000. Is that clear? Hope now you'll be able to understand. Apart from that, finally, loan is repaid. Borrowing the loan and repayment of loan not being the revenue nature. So remove it. Borrowed and repaid, it's not income and expenses. But while repaying, you are paying 2 lakhs extra. The interest is the expenses can be shown here. This being 200,000. Now tally this and find out the balance. Probably 10,000 thousands. You get the balance being 1890. Am I right? Should be shared. This is the profit, net profit, like shared among the 3 joint venturers A, B, C. They share equally. Okay, you share equally. So 630 for A, 630 for B, and 630 for C. Hope now you'll be able to understand this one. Okay, clear? Now, we will not stop with this. We need to prepare what? One more thing. Okay. And the joint venture account in the books of each venture. So, this is the account maintained commonly. A needs to know how much I have to receive from them. B wants to know how much I have to receive from the joint venture business or joint venture operations. So, they need to maintain their own books of accounts also related to their own receipts and payments. So that will be called a joint venture account in their books. Okay, let's see. It's not so complicated. It's very simple only. Okay, we'll try to finish up. Here, in the books of A, joint venture account. Similarly, in the books of B, joint venture account. In the books of C, joint venture account. Is that clear? Now, come on. How can we post this, sir? Very simple. I'll guide you here. Now, what A needs to get and what A needs to give. If anything supported by A to joint venture, that will be asset for him. If I give 10,000 rupees to you, what happens? You are my debtor. The moment you return, your debtor's balance is closed. Similarly, A gives some money to joint venture. Right, that will be debited. When he gets it back, he is going to credit. That's a very simple. Come on, tell me. Here, what are the things are going to be posted? He borrows this money first of all, related to this. Okay, to loan borrow. You forget about the loan. Rest you can finish up first of all. You make the payment for what? Okay, you make the payment for what? Okay, this one 60,000, 6,000, right? And what more? You paid for registration fees. You paid for the 6,000. Out of 6,000, by way of loan 5,000 you arranged and settled. 1,000 is out of your pocket money. Can we assume this way? And what about this 60,000? Also paid by his own pocket money, 60,000 rupees. Okay, so he invested 1,000 rupees out of his pocket money, another 5,000 rupees borrowed and invested, another 60,000 for the registration he invested out of his own money. Right, all these things are the debit balances. So he has given, now all these things are asset. And what he gets in return, come on, tell me, by bank for what? Sale of the flat, 4,000 rupees. Apart from that, he takes one flat for how much? 1,000 rupees. Clear? Now, he has to pay interest also. Bank. Keep it the other side. Okay. Bank. The value being 200 rupees. Is that okay? What he pays, no, all these things are recoverable from him, from joint venture. So these things are debit item. The amount recoverable from the joint venture are shown in the debit side. The amount recovered from the joint venture will be credited by showing in the credit side. Very simple. What he supported? 6,000 rupees, 60 rupees, 200 supported. What he got in return? 1,000 rupees and 4,000 rupees and 1,000 rupees they received. Apart from that, why do I want to do these operations? To get some profit share only, no? Did he get it? Yes, he gets 630. If he wants to get it, then automatically is also increasing the value. Okay. So this is what about the profit share, profit from the joint venture. This is 630. That's all. So he has invested 6,000 rupees and he has paid the money for registration. He has paid the interest and he is now allowed to get the share of profit, which is 630. These are the amount he wants to get it from the joint venture company. And he already got around 4,000 rupees by selling the flats, and he got one flat also, 5,000 rupees already received. Balance, how much he has to receive? 1,000? 890, I think.
Yes.
1,890 he has to get it from. So overall value being 6890. 6890. What you have to debit, you can remember very easily. All the support given by A for that he is supposed to receive will be debited. In return, what he gets should be credited. So he supported these 4 items out of his pocket money. Apart from that, because of involving in this venture, he gets another 630. So much money he has to receive. This will be the debit balance, means asset. And he got 4,000 plus 1,000, 5,000 rupees already received. Balance 1890 is recoverable. From whom? Okay, we'll see that later. Either it may be recoverable from B or C or both. We'll see that. We'll solve B account also. Now come on. In case of B, what are the expenses he incurred? Okay, to bank. For what? Material. How much is that? 450. And from his own godown, the stock available in his godown is usually in purchases, can be subtracted. It's a drawings are transferred from the purchases to this one. The value being 500. Either you can name this being the purchases or stock, own stock. Okay. Now, then what happens? He is eligible for his share of profit also, profit from the joint venture, which is 630. What he gets in return? So he gets sales collection of some flats for rupees 2000 rupees. Apart from that, he takes one flat, which is 1000 rupees. Now tally this: 3000. Here the balance is appearing in this side. 1420. Am I right? 1420. What does it mean? A has supported lot, so he has to get 1890. B has supported lesser, so now he has to pay to the joint venture. The money payable by B will be taken by the person who it may be receivable. So A is need to get this much money, and B has to pay this. The amount received from B is taken by A. Do the same for C also. In case of C, what are the support given? For expenses, the value being 900. What he gets in return? Apart from that, of course, he is eligible for profit share also, which is around 630. And for that, come on, what we had to do? The collections of sales will be taken by him, 1000. Apart from that, one flat is also taken, 1000. Now, if I tally this, 2000 rupees he is given extra, but his contribution is 900 plus 630, 1530 only. His support is 1530, but he has taken benefit 2000 rupees. It means he has to return to joint venture. How much is that? 470. Now, come on. These two have to pay this much money, 1420 and 470. If I add up this will be equal to what? You will get this one. So this 1890 is recoverable from B as well as C in their balance amount. 1420, 470. Here A account. Here A account. Is that clear? So consolidated profit and loss is nothing but normal profit and loss, like you can prepare. It's only for temporary reason. Thereafter, the business will not be continued. But for the independent account, they will prepare joint venture account. Joint venture is what? Personal account, like you can treat. If I give the money, I will be debiting. If I receive, then I will be crediting. Okay. What I give, whatever the transaction increases, the amount recovered from this, from them will be debited. In a return, it's going to be credited. That's the logic you can keep in your mind. Clear? So all this support given by A to the joint venture, and this support given by B for joint venture, and this one support is given by C. Because of involving this venture, they will be eligible for the share of profit. Finally, there may be shortage or surplus. If there is a shortage, they can get it from other venturers. If there is a surplus, they have to settle the money to the other venturers who are to be paid or sacrificed. Right? So this is the logic. Clear? This will be equal to this value. This is what about the jointly controlled operations related illustrations. Let me brief the jointly controlled operations theory. Jointly controlled operations, the main features, okay, main features. Each venturer has his own separate business. In this illustration, A, B, C will have their own business also. There is no separate entity for joint venture business. For this one business, they don't have separate business. Okay, for the new operations, buying the land and constructing the flats and selling, for the new operations, each and every venturer will support out of their own fund, and all the three venturers will do sales operations also for this. Whatever the leftover will be shared by them, right? All ventures are creating their own assets and maintain them. I will deposit and I will keep the record what I spent and how much I need to recover. All these things are there maintaining. They will create their own part of assets also in the jointly controlled operations. Each venturer record only his transactions. So ABC maintains his own books and only related to their own assets and liabilities details alone. Okay. without any separate set of books maintained for the joint venture business. And there is a common agreement between all of them. Venturer use their assets for the joint venture business. So here, what happens now? B has given his own existing stock for this business. A has borrowed money from his personal capacity as well as use that money for purchasing the land. So they can use their own assets, their own liabilities, their own other resources for this common joint venture business. Venturer met the liabilities created by them. Venturers met the expenses also, and any income earned and revenue generated from the joint venture is shared by the venturer as per the contract. Hope you will be now able to understand the features. If you are able to understand the illustration, you will be now easily connect the features also. If you are asked about joint venture operations, you write the features. And in respect of its interest in JCO, okay, their own interest, whether you are holding 30% or 40%, that will be called as interest in JCO. The venturer should recognize in its separate financial statements and consequently in its CFS. Okay, they have to show in CFS as well as separate financial statement. Okay, they may prepare SFS financial report as well as CFS financial report also. So they have to incorporate both. Okay, in CFS as well as SFS. Separate financial statement as well as consolidated financial statement if they want to prepare consolidated financial statement. The assets that it controls and the liabilities that it incurs should be recorded. The expenses that it incurs and its share of the income should also be recorded. So this is nothing but already I told you, in A's book, joint venture account is open. All the assets are whatever the expenses incurred by A will be debited, and profit share also be debited. What in return he gets, that will be shown here. So this will be shown properly in their respective account, right? Separate accounting records may not be required for the joint venture. Separate accounting records not required. Okay. Separate accounting records for the entire jointly controlled operations not required. That may be commonly maintained for the verification purpose only. The venturer may prepare accounts for internal management reporting purpose. This will be not required, but sometimes they may prepare the accounts also for the internal requirement alone. Is that okay? So whatever the assets and expenses spent for the joint venture will be their own assets, and in return what they get will be subtracted. Balance will be identified as investment in your joint venture business. So that's what about the topic. Okay, financial reporting, that interest in joint venture business. In the consolidated financial statement, they will show interest in joint venture operation being so much until it is closed. Once it is closed, tally. Until it is closed, any amount you invested remains asset in the balance sheet, in CFS balance sheet. Is that clear? Hope now you will be able to understand the JCO concept. JCO is over. Let's move on to the next one, jointly controlled assets. Very simple. A and B both put together will hold an asset. Okay, A spend around 60 lakhs and B spend around 40 lakhs, and together with they purchased an asset for 100 lakhs. Okay, 60 lakhs and 40 lakhs. Is that okay? So year on year, 60% on the value of the asset will be clubbed with the assets of A company. 40% will be clubbed in the books of B company. That's all. That's all about jointly controlled assets. Now, let's see here. Let me try to solve this illustration for the jointly controlled asset case here. Now, A Limited, B Limited, C Limited decided to jointly construct a pipeline to transport the gas from one place to another that was manufactured by them. So they want to develop an asset. What asset? Pipeline to transport gas. Pipeline. For the purpose of following expenditure was incurred by them. Building 12 lakhs. Building 12 lakhs. Is that okay? So, pipeline 60 lakhs, computers and other electronics 3 lakhs, various vehicles 9 lakhs. They also decided to equally bear the total expenditure incurred on the maintenance of the pipeline that comes around 6 lakhs each year. You are required to show the consolidated balance sheet. So this pipeline is a separate asset. Now you have to prepare a balance sheet for the pipeline alone separately. That is called consolidated balance sheet for the pipeline. Right? Consolidated balance sheet. This is jointly controlled asset. What asset is this? Pipeline is the asset. The asset is constructed by ABC by investing some amount by themselves. Is that okay? And the amount invested by these three will be equally shared. Okay, equally. We assume these investments are equally shared. Now, come on, tell me. How do you prepare the balance sheet here? Equity and liabilities, and second one being assets. Second one being assets. Is that clear? Now, what are the assets they have? Building, maybe named as property, plant, equipment. Property, plant, equipment, 12 lakhs, 1200,000. Depreciation applicable for that being original value. Depreciation applicable for this being 5%. Come on. 60,000, and WD value being 1140. Similarly, pipeline 6,000 thousands, depreciation 15%, 900,000, balance being 5,100. And we have computers, the value being 300,000, depreciation 40%, 120, 180. Okay, then one more item, vehicles, the value being 900,000, depreciation 20%, 180, then ultimate value being 720. Property, plant, equipment. What is the total value? I hope the value being 7440. So 7440 will be the property, plant, equipment. 7140. Okay. Property, plant, equipment 7140. What about the equity? Equity share capital. We assume the equity share capital also 7140. I assume this will be the working note number 1, equity share capital. How much is that? 7140. This will be the schedule number 2, note number 1 and note number 2. Note number 2, 7140. So 7140. It's very simple, right? So preparing the consolidated balance sheet is very simple. They have only assets, post all these things in the assets. And you assume that those things are equally contributed, so show that as an equity and liability. So what is the expenses are? Total expenditure incurred. The expenditure and depreciation might have been already adjusted in P&L account. We understand that the 7140 will be the net capital after the expenses and the profit, right? That's how we can assume. If you are supposed to prepare the consolidated balance sheet, the P&L account, you can incorporate the depreciation and other things there, but we are not going to worry about that here. Usually what happens, there will not be revenue here. There will not be revenue. Why? Why there is no any revenue? They are holding the asset only for their purpose. This asset is used by these three parties only, that's all. Collectively constructed, and all the expenses for running that will be managed by themselves, right? That's all, very, very simple. In A's book, okay, this 6 lakhs may be shared. 6 lakhs is spent by all the three, right? Also, they also decided to equally bear the total expenditure. Then 2 lakhs is spent by A, B spends 2 lakhs, C spends 2 lakhs. So what happens now, in the P&L account of A Limited, they simply debit the expenses 2 lakhs. Debit the depreciation. Depreciation how much? How much is going to be debited here? For vehicle, building, pipeline, and computers. They have to debit equally for them. Okay. Now I have given the space here to make you understand this vehicle held not only by individual person, by three parties. So share this for all the three A, B, C. 300, 300. We assume all the three holding equal rights. Okay. 60, 60, 60. And this ultimate value being 380, 380, 380. Okay, now depreciation in A Limited's P&L account for vehicle being 60 rupees. Similarly, for building A, B, C, 400, 400, 400. And here 20, 20, 20. Here 380, 380, 380. I think this value is wrong, right? Okay, I'll correct. This being 240. Okay. 240. Okay. Is that okay? Now here pipeline also for ABC equally share 2000, 300, 600 for A, B, C. Clear. So the depreciation for vehicle 60, for building 20, for pipeline 300, and for computer A, B, C. Okay. 1700. So I didn't get the space, so I put the vehicle top, so I missed to see the answer, right? Okay then. Now here what happens? Come on. 100, 100, 100. What about this 120? 40, 40, 40, 60, 60, 60. Okay, good. So here this will be 60. Now what happens in A Limited's balance sheet, P&L account, they debit 200 rupees for the expenses, depreciation for all the assets. To their extent, debited here. What about the revenue, sir? There is no revenue, but they have the options to use it. Otherwise, they have to purchase the asset or they have to get it in rental somehow. Now they own the asset. They are spending the money for maintaining that, and they are enjoying using the assets commonly, not by A alone. A, B, C all put together they will be enjoying. In their P&L account, they are debiting the expenses related to their own extent. Right. We prepare the consolidated balance sheet only for the jointly controlled assets. Apart from that, this equity share capital also be shared. For whom? A, B, C. How much? Equally shared. 2380, 2380, 2380. Apart from that, you have to prepare A Limited is completed, P&L account is completed. Balance sheet of A Limited should be open. How that should be? In case of balance sheet of A Limited. Okay. So, balance sheet of A Limited. You will get A Limited balance sheet. A Limited balance sheet. In A Limited balance sheet, you get all the things, but you have to show non-current assets. Property, plant, equipment. How much is that? You have to add these values. 300, 400, 2000, 100. Separately you have to work out. What is the total value? After the depreciation. After the depreciation, come on, tell me the value. 2380. 2380. Hope you will be now able to understand. So I prepare the consolidated balance sheet. Apart from that, how this will be incorporated in A Limited also. All the expenses debited in the A Limited's P&L account. While preparing the balance sheet of A Limited, to the extent of assets in the consolidated balance sheet will be shared. To the extent A holds will be incorporated here. Is that okay? Of course, the breakup is need to be explained in note form. You just go and refer the Singar Academy's material. Similar to A Limited, you prepare for B and C also. Naturally, in this case, equally holding. Sometimes it may be 40, 30, 30 or 50, 30, 20 also. If the ratio is different, calculate as per the ratios and prepare. In case of jointly controlled asset, you are going to prepare the balance sheet for the jointly controlled assets, and any expenses related to that jointly controlled assets, including depreciation, will not be shown there. It will be shown in the concerned parties P&L account only. And the jointly controlled assets, to the extent one of the joint venture holds, no, will be incorporated in their books. Is that okay? Jointly controlled entity and a small theory will continue in the next class.